Now, I don't know about you, but for me, this year has gone by a lot quicker than usual. We're already in the middle of September and we're stepping into Q4 very, very soon. So for this week, I want to make a video on the top 10 tax saving tips that you want to keep in mind as we're moving towards 2022. Now, before we start, as always, if you haven't already, make sure you click the link in the description to join my private group on Facebook. On there, we'll be sharing different contents and also you can ask questions, and we have a lot of different professionals in the group that can answer you as well. So if you haven't already, make sure you click the description to join below. Now, without further ado, let's jump into today's video. Alright, so the first year-end tax saving tip is tax loss selling. Just like when you make money, you have capital gain in your non-registered account. When you lose money in there, you also have capital losses. Now, capital losses can only be used to offset capital gains. You could also use it backwards to offset the previous gains in the last 3 years. And if not, you can also carry forward for indefinitely. So for this year, if you have some capital losses from your investment and you have other capital gains elsewhere that you're about to trigger, or your previous gains that you pay taxes on already, it might be wise for you to trigger your capital loss on purpose by year end, just so you can claim that next year April when you file your tax. Now, do keep in mind, if you trigger on purpose by selling your investments, you cannot buy back the same thing within 30 days or else your capital losses will be denied by CRA. This is called the superficial loss rule. Also, you do not want to trigger your capital losses in your non-registered account by directly transferring that investment into your TFSA or RRSP. If you do something like this, the capital losses will not be allowed. So instead, if you want to put it back into your RRSP or TFSA, you have to sell it first, have it as cash, and then transfer that cash into your TFSA or RRSP afterwards. Now, on the other hand, similarly, if you have some capital gain that you're thinking about realizing, but this year your income is already very high, if possible, or if you're comfortable with it, then you might want to delay your capital gain realization until next year. Some of my clients are going through this where they have made too many buy and sells during the year already. Their tax rate is extremely high. Any more changes to the investment, if it's not urgent, they should wait until next year when the tax bracket resets. Now, moving on, another tip is to restructure your interest that you're paying right now. If you currently owe any debt that is not for investment purpose, any interest you pay right now is not tax deductible. So if you're someone in this position and you have some non-registered investment elsewhere, a smarter way to do things is to sell your non-registered investment, use that money to pay down your borrowing, and then you want to borrow the same amount back out but to reinvest that money. That way, you will still owe the exact amount as before. You will also still have the non-registered investment as before, but the interest cost you'll be paying from now on will be for investment purpose. And what that means is you can write that off from your income. So this will be a more efficient way to set up your debt structure. Now, before you do something like this, check the capital gain that you will be realizing by selling some of your non-registered investment. And also keep in mind the superficial loss rule that we just discussed about in point number 1. Now, next, another tip is to consider contributing towards your spousal RRSP instead of your own RRSP. This is usually better for families with a discrepancy in the income earned between spouses. Now, spousal RRSP basically works exactly the same as before. You're still writing off the higher income person's income using the higher income person's RRSP rule. The only difference is now the RRSP is owned by the other spouse, which is at the lower income. Now, you want to do that because when you draw it back out eventually when you retire, it will be counted as the other spouse's income, the one with a lower income, since it's under that person's name. If that spouse is always going to be a lower income, or that spouse doesn't have a pension plan whereas you have, then very likely there will be a discrepancy when you retire as well in terms of retirement income. So by using spousal RRSP, this is how you can split the retirement income and make it more even while not sacrificing the write-off that the higher income earners will enjoy every year. If you do this for many, many years, the tax saving you will get by the time you guys retire could make a massive difference. Now, moving forward, another tip is to withdraw your RRSP or spousal RRSP if suitable. If this year you have a much lower income than usual, then it might be beneficial for you to withdraw some of your RRSP back out just because you're at a lower tax bracket. Now, similarly, you can do the same thing for spousal RRSP if your spouse is at a lower income tax bracket for this year. However, if you're doing this with spousal RRSP, keep in mind there are more rules to make this work, or else any withdrawal that you make from your spousal RRSP will be attributed back to you, which is the higher income tax bracket. So you don't want that to happen. Now, speaking of withdrawal, you also might want to consider withdrawing for your TFSA if you need the money. when it comes to TFSA and the contribution room, it's actually very confusing for most people. One thing to remember is that TFSA room limit does not care about your withdrawal, but only about your deposit. So what that means is, let's say this year you have a 10K TFSA room and you put 10K in. Next day you take the 10K back out. Just because you withdrew that amount back out, it doesn't mean now you have the 10K TFSA room freed up for you to put money in again. You have basically lost the room until it's January 1st of next year where the room will reset. So since whatever TFSA you draw out, you will only get that exact room back on January 1st of next year. Typically, if you really want to draw money, it's better you draw from your TFSA towards the end of the year so your room gets reset very quickly should you want to reinvest that money back into your TFSA. Now moving on, we can look at income split. You can actually split some of your investment income via loans between family members. Sometimes in a family, someone is at a very high income tax bracket and they don't want to make any more investment income because that would just go into the highest bracket as well. Now, usually you cannot give that money to your family member to invest through them because any income it makes in there is just going to get attributed back to you and taxed at your tax rate. Instead, to do this, what you can do is actually draft a loan agreement between you and the family member you want to invest through. Now, doing so, you will have to charge them the CRA's lowest prescribed rate that's posted every quarter on their website. For now, 2021 Q4 is still listed as 1% as prescribed rate. And once the loan is implemented, the interest rate do not change. It stays at the current prescribed interest rate whenever the contract is written for the whole duration of the loan. But one thing to note is any interest owed must be paid by January 30th of the following years, or else you will face with attribution rule again. And if you have done this already but at a much higher prescribed rate percentage, there are also steps you can follow to re-prescribe at a much lower current rate. Now for this, I definitely hire you to especially consult a CPA on this to make sure you do everything and you set it up correctly. Next, moving on is to plan your donation right now. Now in the previous video, if you haven't watched already, you can check this out, but we have talked about donation in detail and what are some rules and calculations to make donation more effective. So by now you should know for this year how much you have donated and also how much you have carried forward from previously. If you're not hitting a $200 mark this year, you might want to plan to not use donation and carry it forward. Or if you have any carry forward donation that is about to expire because the 5-year is up, then you might want to donate a little bit extra this year. Use what's about to expire to carry you forward the $200 mark. Now also, if you're planning to sell some stocks or investments and then donate that money to a charity, a better way to do it is to actually donate that security in kind directly to the charity of your choice. Doing so will not be considered as a sale, so you will not have to face the capital gain, and also you will get to enjoy the same donation tax credit as before. So that would be a much better way of doing things if you're planning to sell some investment and donate some of that money away. And next tip is to potentially shift some of your expense or income if it's suitable. Now this is going to be more for self-employed or maybe corporate owners, but the idea is that you want to by now look at your overall income to date and see what kind of tax bracket you're in versus the expense that you can be writing off. After taking everything into account, if you expect your income tax bracket to be a lot higher this year, then you may want to consider delay paying out yourself until it's next year January 1st if possible. Likewise, if you expect this year's overall income tax bracket to be much lower than what you might face next year, then you might want to pay yourself a little bit more right now this year just so you get to enjoy a lower tax bracket. Now the same thing can be said with expense. Sometimes, for example, myself, I will look at my expense for a whole year, and if I feel like my income versus expense, I have enough expense to keep me at a lower tax bracket, and I have some big purchase that I could delay for a couple of months just to tie over to next year, then I might delay that until next year so that I can enjoy a much more efficient write-off. Now for self-employed or corporate owners, the best way to get an idea of your income is to open up the account that you always receive money in, add up all the deposits to see what is the rough amount. And for expenses, I recommend you not to keep physical, receipt because those can get lost or fade away. And instead use something, for example, like a cam scanner to store everything in one place. As you see on the screen, that's something I've set up for myself. It's very organized, so I always know where all my receipts in. And around this time is the best time to start your Excel to look at all your expenses together just to see how much you can write off versus how much you have paid yourself already. Now, finally, for the last two tips, these are more for corporate owners. But the first one is to consider maybe or may not want to pay your family members. You can actually split income potentially by paying your family members. However, keep in mind there is something called tax on split income, the TOSI rule, which basically is a bunch of restrictions that a family member has to fulfill in order to prove that they are actually adding value or bringing significant contribution to the business to justify whatever salary they're about to receive. Anytime they fail to hit the TOSI rule, the income will be taxed at the highest tax bracket. Now, this rule is pretty complicated. There's a lot of things to read through, but I posted a link down below if that's something you're considering. And I definitely recommend you talk to a professional CPA to make sure you're okay to pay salary to your family members. Now, finally, is you want to align your corporate tax filing with your personal tax filing timing. So here, personally for myself, and also whenever someone asks me, I would highly recommend they have the corporate end year at the later half of the year, at least after July, preferably probably towards October, November, or December. This actually allows you to have a lot more flexibility when it comes to your corporate tax, because around that time, you would also know from your personal side how much you have paid yourself already and what is the expense looking like. So for example, for myself, I have my corporate end year at October 31st, and around that time, I should know about my personal income. If I feel like that year is too low after all the write-off, then I might want to bonus myself or dividend myself anything extra because I will be at a lower tax bracket anyway, and vice versa. And sometimes when you run into specific situations or scenarios where you might need more or less money, then you might want to consider to do other things like deferring bonuses to yourself or loan yourself money directly from your own corporation if that will give you a better tax setup. So this is why if you are planning on setting up corporation, or if possible, then you might want to change your corporate end year to at least Q3, if not Q4 of every year, just so you have a better alignment with your own personal tax. Alright, so today is a much quicker video. I just want to share some tips with you. If you liked all the tips, hit the like button once. If you do not like them, then hit the dislike button twice. And what I want to do next is hear from you. What is your end year tax saving tips that you usually visit? Let me know in the comment below so I can learn from you as well. And as always, if you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you like and subscribe to the channel, click the bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye.